Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenberg from Whittenberg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
A trusted advisor will admit they don't know everything. So when expertise is needed in a specialty, they reach out to an expert. At Whittenberg Wealth Partners, they do just that. And Austyn Whittenberg is here with Darin Fullmer, a CPA with, some credentials that could really make you jealous. So Austyn, tell us more about Darin and this show's focus.
Thanks, Patrice. Yeah, today we wanted to spend some time talking about a few tax ideas for 2022. And as I'm not a specialist in taxes, I thought I'd bring on Darin Fullmer from Haynie Company, who's a CPA that I do a lot of work with. And I wanted to spend some time talking with him. You know, at Whittenberg Wealth Partners, we feel very strongly that your CPA, your attorney, and your financial advisor should all work together. And so we want to build these strong relationships and make sure that our clients are working with someone who is up to speed and, is current with their knowledge of tax law. And that's why I wanted to have Darin on today. So Darin, why don't you take a second and just introduce yourself? Tell us a little bit about who you are and what you do.
You bet. Thanks, Austyn. My name's Darin Fullmer. I am a CPA with Haynie Company. So I'm licensed in 2 states. So I'm licensed in Idaho and I'm licensed in Utah. The concentration of most of my clients are between those 2 states, but I've got clients as far east as New York and Florida and as far west as California, Washington. So Haynie Company, we are what I would call a mid-tier firm. So we're not one of your big 4, which was formerly known as the big 8 firms, but we're also not necessarily a small local firm. So we're kind of somewhere in the middle, which I think is a really nice sweet spot. We work primarily with business owners, high net worth individuals, and beyond just tax planning and tax preparation, we view ourselves as sort of strategic business advisors. So, our clients come to us with a lot of questions. Maybe it's a, business sale, or maybe they've got questions about their estate planning. Maybe they're, looking to buy a new piece of commercial real estate. They want to know what the best way to do these things are. So that's kind of where our focus is. And that's, a little bit about me.
Awesome. And that's really why I think we like working with a firm like yours, is that advisor role similar to us. There's any number of online free softwares that you can punch your W-2 in or whatever, and it can calculate the taxes. But those softwares aren't going to give you advice on some of the strategies we're going to talk about today, right? And so now with that, let's just hop right into it and start with retirement plans. For most people, their 401k at work or IRAs, those types of retirement accounts is their main way of saving money on taxes while saving for the future. And I know that the 401k contribution limits went up, and I know that you do a lot of work in the TPA, third-party administrator space. And so I wanted to, just have you quickly update everybody on what the new 401k limits are and how business owners can use that to their advantage.
You bet. So to provide a little bit of context, and, most people are not extremely well versed in 401k plans. So I like to boil it down to kind of basic terms to give people a basic understanding. So with a 401k, you really have 2 types of contributions at a very basic level. You have employee contributions that employees can make from their own paychecks. And then you have employer contributions. So contributions that the employer is making on behalf of an employee. So think of matching contributions, profit sharing contributions, things of that nature. So there's a few limits that govern how much an employee can contribute and how much an employer can contribute to a 401k plan. So the employee limit, if you are under age 50 for 2022, you can contribute up to $20,500 to your 401k plan.
And that's $1,000 more than last year. Is that right?
$1,000 more, which kind of came as a surprise. Usually the IRS indexes those amounts by about $500 every year. I think with increases in inflation that we've seen over the past 12 months, they felt like a larger adjustment was necessary.
Yeah. And I found it interesting there that they raised that 401k limit, but the IRA limit stayed low. It's almost like they're trying to discourage the IRA and get people into their 401ks or other types of retirement plans like that.
Exactly. The IRA limits stayed at $6,000 if you're under age 50 or $7,000 if you're 50 plus. So going back to the 401k, if you're over age 50, you can actually contribute up to $27,000 a year. There's a $6,500 catch up on 401k contributions. So there's the potential that if you're 50 plus, maybe you're close to retirement, and you want to accelerate those contributions a bit more, you've got the flexibility to do that. So the second limit that I want to refer to is kind of the overall contribution limit for a 401k plan. So in aggregate for a 401k plan, employer contributions and employee contributions cannot exceed $61,000 if you're under age 50 or $67,500 if you're 50 plus.
That's a pretty big number. I think most people don't realize that you can get up to that point. Now there's, you got to have a business who wants to do profit sharing contributions and some of those other types of things to really get there. But I think most people just think I can get that 20,000 or the 19.5 to 25 in there. But there's, if you really look at it and structure it the right way, you can, that's a pretty significant amount that you can get into those plans.
Exactly. So, if you're just working as maybe a W-2 employee, it might be a pipe dream to think that you're going to get that $61,000 into the plan each year, because there are limitations on what your employer is willing to contribute. So you can always most likely maximize your salary deferral contributions, but there may be limits of what your employer is going to contribute on your behalf. But if you're, a business owner, especially if you don't have employees, you have a lot of flexibility to contribute up to that maximum. Again, if you are a business owner and you have employees, there may be limitations on how much you can get into the plan, but it is a lot more robust than what people think on the surface level.
So let's talk real quick. I think for maybe an underutilized plan from a business owner perspective, is that simple IRA sort of fits right in between that IRA and 401k limit, where you can't, if you think you can do more than your 6,000 or 7,000 into your IRA, but you're not really going to be able to do the 20,000 or north, in a plan like that. What's the best option there?
Yeah. So with a simple IRA, if you're under age 50, you can contribute $14,000 in salary deferrals. And if you're 50 plus, you can do $17,000. So with a simple IRA, there's a $3,000 catch up. Similar to a 401k, the simple IRA does allow for employer contributions. Again, they're not, maybe as robust as the 401k, but it's a good middle ground between the IRA and the 401k if you want to kind of find that sweet spot. So yeah, a simple IRA makes a lot of sense for a lot of business owners.
One of the other really underutilized tax strategies or savings vehicles here is the HSA. I have an HSA personally. We have that in our company plan here. And it's a really great way to be able, if you're bumping up against those limits, to get additional tax deductible contributions going into a plan, but can be really powerful down the road as you invest those funds and allow them to grow, and ultimately end up using those for health insurance, health costs, I guess I should say.
Yeah. The health savings account I think it's really underutilized. Probably the most underutilized tax planning strategy out there. So with a health savings account, the contribution limits vary depending on whether you're single or whether you have a family. So, but what most people run into, Austyn, is the inability to deduct their medical expenses. So let's back up and give a little bit of context on what I mean there. So for your average taxpayer, let's say you have adjusted gross income of $100,000. Your average taxpayer can only deduct medical expenses that are in excess of 7.5% of their adjusted gross income. So let's back up and do the math there. So you've got adjusted gross income of 100,000 times 7.5%. That's $7,500.
Yeah, that's a really, for your average family, that's going to have to be a really bad medical year, right?
Yep.
To get up and above that number.
Exactly. So and then just to reemphasize, it's only expenses above and beyond that 7.5% that are tax deductible. So most people, you're going to have medical expenses from year to year. It may not be that drastic, but you're not getting any tax benefit out of those medical expenses that you're paying out of pocket. With a health savings account, you can contribute up to $3,650 a year if you're single, or $7,300 a year if you are on a family plan. So that's pretty significant. And if the plan is sponsored through your employer and you make those contributions through payroll deduction, not only are those contributions not subject to federal income tax withholding, but they're not subject to Social Security withholding or Medicare withholding. So
I actually didn't know that. So that's a slightly different than on the 401k side, right?
Yep.
So it's even better.
You're saving on federal income taxes. You're saving on Social Security, which is 6.2%, and you're saving on Medicare, which is another 1.45%.
So that's a really, really powerful strategy then.
Exactly. And it's really the only account out there that you can put dollars in tax-free. And if you use it for qualified purposes, those dollars come out tax-free as well.
True. That's a really important point. We didn't actually mention when we're talking about retirement plans, the Roth options, right? Where you can pay the taxes today, put the money in, grow tax-free, take it out tax-free. But there's no way to get a deduction and take it out tax-free in a Roth plan or something like that. But in the HSA, that's like triple duty dollars there. Bang, 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 all these different really good tax benefits.
Yeah. So if you're like me, we have 5 kids. We're going to hit our deductible almost every year. So our health savings account is a huge tax saver for us. And it's a way for us to turn those medical expenses that we know we're going to have into tax deductions. So some of the requirements to contribute to a health savings account, and again, talk to your health insurance professional. If you're wondering about, which policy you should be getting on, if you're looking at, maybe the healthcare exchange, or maybe you have a plan through your employer, talk to your HR or benefits person to make sure that the plan is HSA eligible. But usually if you have a high deductible health plan, which for a single person is going to be $1,400 a year, your deductible. And if you're on a family plan, it's $2,800 a year. So it's gone are the days when my parents had, a $500 deductible on their health insurance.
Yeah.
Most plans today are, going to be in that high deductible health plan range. So if you meet the definition of a high deductible health plan, you might be eligible to contribute to an HSA. There are certain stipulations on, the maximum out-of-pocket expenses under the policy. So you want to look at that. But I want to go back really quick to the contribution limits there. So $3,650 if you're single, $7,300 if you're on a family plan. And if you're 55 plus, there's $1,000 catch up. So unlike our IRAs and our 401ks that have the catch up provision at age 50, the HSA is actually age 55. So I think they're just an amazing tool. So just turning health expenses into tax deductions. But the other thing I want to mention, Austyn, is that HSAs, that balance can accrue and grow from year to year. It's not a use it or lose it proposition like it is with a flexible spending account. So with an HSA, if you contribute $7,300 and you don't have any medical expenses that year, that balance carries over to the next year. And in that next year, you can contribute another $7,300. And the reason that that's important is a lot of retirees, medical expenses are their number one expense in retirement. So instead of pulling money out of an IRA or a 401k and incurring the tax liability to cover medical expenses, a lot of retirees, it makes sense for them to, contribute to an HSA over time to help cover those medical expenses in retirement.
Yeah. And as far as I know, most HSA providers have investment options that you can use inside of there. So if there's money left over, throw it in some of the investment options they have there and try to get that to grow over time.
Yeah, exactly. If they've got an option, something other than money market, and you want to try to grow that money even more, those options are usually available with most HSA providers.
All right. So that, I think, we'll put a little bow on the qualified plans, and retirement plans there. And let's move on to a few other areas. I think probably one of the most common sentences I hear from a lot of our clients, especially those that are business owners, is, hey, I'm trying to save on taxes. I'm going to go buy an $80,000 truck so I don't have to pay taxes. Right. And I always, jokingly say, well, if you need a truck, you do that. But just so you know, an $80,000 truck doesn't save you $80,000 in taxes. So, I think people have a hard time equating in their brains, what can I deduct as a business owner, or, even for non-business owners, like charitable expenses and some of those other things, how do these actually impact somebody's tax situation? So, how do you have those conversations with your clients?
I run into the same questions probably even more often than you do. So, but with let's break it up. Let's talk about kind of our business owners first, and then let's back up and talk about, non-business owners. What things can they deduct on their personal tax returns? So for business owners that, file a business return, really the standard is that you can deduct any ordinary and necessary business expenses. That is straight from the tax code. So it's a little bit of open to interpretation, I would say. But when you kind of dial in on the tax code and what's deductible under certain circumstances, we've got a fair amount of direction in the code. So ordinary and necessary. So that's going to vary from business to business. It's going to vary from industry to industry. But the important thing to understand, and you alluded to this, Austyn, is that an $80,000 tax deduction is not saving you $80,000 in taxes. So that $80,000 deduction is only saving you taxes based on your marginal tax rate. So on the federal tax side, we're in a progressive tax system, right? So we have tax rates ranging from 10% all the way up to 37%.
So can you do 80,000 times 37% on the top of your head? I'm trying to make you to do hard math here.
Oh, let's see.
Maybe we should say 100,000 just to make the math easy, right?
Yeah, there you go. Yeah, $100,000 deduction, 37 grand. So yeah, if you've got $100,000 deduction and you're in that top tax bracket on the federal side of 37%, it's going to save you 37% in taxes. You also have to factor in state income taxes. The state of Utah, has a flat rate, roughly 5%. So you have to figure in your state income taxes as well. But it's not a tax credit. A tax credit is a dollar for dollar reduction to your tax liability. A tax deduction is kind of a marginal reduction to your tax liability.
Yeah, I really do think that is something that people just misunderstand. Poor elementary and high school education around the concept of taxes. All right, what about for non-business owners, just regular W-2 employees of a business? What sort of things can they deduct?
Great question. So I'll dial in on we've already touched on IRA. Taxpayers can deduct IRA contributions or, 401k contributions through their employer. If they're participating in an HSA, they can deduct those as well. I really want to touch on what we call itemized deductions. And this is another very confusing topic for taxpayers. So itemized deductions are things like property taxes, state income taxes, mortgage interest, charitable contributions. So if those deductions in aggregate exceed the standard deduction, which is kind of a free deduction the government gives you, then you can opt to itemize your deductions. So one thing it's important to note that there is still a cap on property taxes and state income taxes that you can deduct. It's capped at $10,000.
They're looking at taking that away. Wasn't that in some of the, I know we don't want to spend too much time on what the proposals are because who knows by the time this comes out or people, who knows what they may be, but that is one of the things they looked at removing, right? Was that cap?
Correct. Yeah. So we'll see what happens in Congress and what they get done there. That cap may go away. It may not. It's just yet to be determined. So we'll see where that goes. But there is a cap on, property taxes, state income taxes. Most people hit that limit pretty quick. You can deduct your mortgage interest. So, but there is a qualifier on that. So if your mortgage originated before December 16th, 2017, you can deduct mortgage interest on that debt up to $1 million in debt. So if you have a mortgage for 1.5 million, you're not going to get that full mortgage interest deduction. If the mortgage originated after December 16th, 2017, that debt ceiling comes down to $750,000 for a married filer. So again, there could be a potential limitation on your mortgage interest deduction. A couple of years ago, it used to seem like, oh, those must be, luxury homes. But in the real estate market that we're in, you can hit that $750,000 cap pretty easy.
Pretty quickly. Yeah, you're right.
So one thing to keep in mind there, that mortgage interest deduction may get limited. And then, just touching on charitable contributions. So for the 2021 tax year, you can actually deduct cash donations that you make up to 100% of your adjusted gross income. That was not the case prior to 2020 and 2021. So that limitation is going to go away in 2022. That's something that taxpayers need to be aware of. They won't be able to make that election to deduct 100% of their charitable contributions. Let's back up. So going into 2022, any cash donations you make are tax deductible up to 60% of your AGI. So if you've got, again, 100,000 in AGI, you can deduct charitable contributions up to 60,000. If you're donating, some sort of appreciating asset other than cash, like a stock or something like that, the deduction limit goes to 30% of your AGI. So there are limitations on assets that you're donating to charity that are not cash.
Yeah, I'm glad you brought that up too, because that's another I know the deduction limits, but the reality of it is most people I don't think get too close to that 60 or 30, 30,000. If they're just, giving some money to the local food bank or whatever the charity of their choice may be. But gifting those appreciated shares, that's another sort of two birds with one stone type of gift, right? Where you can get the tax deduction, but you also avoid the capital gain on selling that stock. And so that can be a really powerful strategy for people. You want to, and, given where the standard deduction is, what we try to help people is, I want people to give to charity. We have in our sort of pyramid of client services that we talk about, we always bring up charity and making sure you're giving back, but we don't want your charitable contributions to go to waste from a tax perspective. And so we may look at strategies. One of the strategies that's come up is bunching, where if you consistently make charitable contributions every year, but you're not getting over your standard deductions. You're not really getting the tax benefit from those gifts. We may look at having you do 2 years in 1 year, right? So you get up and above that number. Is that, is that the right idea?
Yep, exactly. So let's say you don't, just for simplicity, you don't own a home, so you're not paying property taxes, you're not paying mortgage interest, and your only itemized deduction is your charitable contributions. And again, for simplicity, let's say you're doing $20,000 a year. So if we look at 2022 and 2023, you're going to donate $20,000 to charity in each year. For 2022, the standard deduction for a married filer is $25,900. So if you take $20,000 in 2022 and contribute that to a qualified charity, you can deduct that on your taxes, but it's less than the standard deduction. So you're not really getting a whole lot of benefit out of that. So you get, between those 2 years, you've got essentially $40,000 in deductions. But let's maybe opt for, hey, let's bunch those charitable contributions. Let's pay all $40,000 in 2022. And then in 2023, we can take the standard deduction of $25,900. So between 2 years, we've actually kind of leveraged the charitable giving to where we now have $65,000, $66,000 in itemized deductions between those 2 years. Whereas before we were pretty much limited to just the standard deduction of $25,900. So bunching your charitable deductions, doing multiple years in 1 year is still a good strategy.
Yeah. And obviously you've got to have the cash or other things to do it. So there's a lot of planning that goes into this, but that's, I think, one of the reasons why you want to be working with the CPA, working with the financial advisor, so we can help you plan for some of these things to really make sure you're taking advantage of any strategy that may be out there. So real quick here, as we wrap things up, I wanted to just touch on, ways to potentially defer some income. For high net worth and high income earners, oftentimes maybe their company offers a deferred compensation plan that allows them to defer some of their income into the future. What other strategies do you see for helping people defer income?
One thing that we run into a lot is a business owner that is selling a business. And do we recommend that they take all the proceeds in the year of the sale, or do they structure the sale on more of like an installment basis where they get, 1/5 of the proceeds every year for 5 years? So we do that analysis, and sometimes an installment sale makes a lot of sense. There is, you want to make sure that you're protected, that you're going to get paid, but that installment sale is good for the following reasons. So if you sell a business for $500,000, if you take that $500,000 now, depending on how the business sale is structured.
Yeah, it does get a little complicated. We don't need to get into too much of the details.
Too far into the weeds, but let's say, you're in that 37% tax bracket. You're going to pay 37% on that business sale on federal taxes. If we do an installment sale where you're only taking $100,000 a year, that will hopefully keep you down in those lower tax brackets. Maybe it's 35%, maybe it's, 24%, whatever it might be. But instead of paying, 37% on that lump sum, we can kind of smooth the income stream over time and take advantage of those lower tax brackets. You still get the same money at the end of the day. It's just you're paying less tax. There's some factors that you want to balance there, but it does make sense for a lot of clients to do that.
Yeah. And maybe most importantly, and this is, I think, where we can wrap things up for the day, but most importantly, it's a lot of these things have to be decided beforehand, right? A business owner can't sell a business, come to you and say, hey, I sold my business. How do I structure it as a structured sale now to save on taxes? Or whatever the planning may be, right? It's getting involved with your advisors early and making sure these things get put in place. Because after the sale is done, or the year is over, there's really not a whole lot we can do to help at that point. It really just, and that's, again, as I mentioned to begin, that's why we value relationships with our clients, other advisors like their CPAs and attorneys, so that we're getting these things done beforehand, as opposed to scrambling on the back end.
Yeah, 100%. So something that I tell virtually every client is that as much, as invested as I am in my clients, I can't care about their own situations more than they do. So there has to be a level of kind of proactivity where they come to us for solutions at the right times, right? So that's critical to what I do. It's critical to what you do, and providing the most value for clients. And, we don't have a crystal ball either. We try to keep good tabs on our clients and have a good pulse on what's going on. But sometimes things come up and circumstances change, and we need the clients to be proactive and inform us of those changes so that we can, again, get ahead of the curve with planning and trying to mitigate, whether it's taxes or mitigate the risk or whatever it might be. So 100% agree with that.
Yeah. If you can have high levels of communication and collaboration with clients, then they really are best served. So, Darin, I want to thank you for coming on the podcast today. Listeners, you can always find us at wittenbergwealth.com, or you can call or text me at 801-839-7056. Thanks again, Darin.
Thanks, Austyn.
And remember to follow Wealth of Insight to know when the latest show is ready for you, and make sure you share with friends and family.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Whittenberg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Whittenberg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.